Welcome to The Explainer. We're going to try and make sense of September 5th, 2025. It was one of those days where the market seemed to be saying two completely different things at the same time. It was confusing, it was contradictory, and we're going to unpack exactly what was going on.
Okay, let's just dive right into the core puzzle of the day. Because seriously, on the surface, things just did not add up. Depending on where you looked, you got a totally different story.
So here's the central question, right? Was it a good day or a bad day for the market? The data from that Friday is a real head-scratcher. It feels like it's pointing in two opposite directions at once. Let's break down exactly why it was so confusing.
And here it is, plain and simple. You've got the SPY, that's the ETF that tracks the 500 biggest companies in the US, and it ended the day down. Not by a lot, but definitely in the red. But then you look at Tesla, a huge, important part of that very same market, and it absolutely surged, up more than 3.5%. So how does that happen? How can the whole be sinking while one of its biggest parts is flying?
All right, let's start with clue number one, the cautious giant. The S&P 500 ETF, SPY, is kind of our baseline for what the overall market is feeling. So what was it trying to tell us? So the broad market ended the day in the red. But here's the really important part. Look at the volume. Trading was heavy, over 85 million shares. Now, whenever you see a down move on high volume like that, it's a signal. It suggests the sellers are serious. There's real conviction behind that push lower.
But this is where it just gets messy, because even if you just look at SPY by itself, the signals were all over the place. Yeah, you had bearish signs like closing down on that heavy selling volume, but at the exact same time, there was over $1 billion in net positive buying pressure. And other technicals were suggesting things were actually pretty strong. It was a total tug of war.
And if you want a perfect picture of that indecision, here it is. The options market is a great window into what traders are really thinking. For every single person betting the market would go down, there was exactly one person betting it would go up. A ratio of 1.00 is perfectly, totally neutral. Traders were literally split right down the middle.
Okay, so while the core of the market was cautious and couldn't make up its mind, out on the fringes, well, that's where the party was. We were seeing an absolute speculative frenzy. This is where the story gets really wild. So Tesla just completely ignored the rest of the market and went on a huge rally. And what was the reason? It was news about a massive new pay package for Elon Musk. This had nothing to do with the broad economy. This was just pure, raw excitement about one specific company.
And to put that excitement into perspective, get a load of this. Tesla's price-to-earnings ratio was over 200. That means investors were willing to pay $200 for every $1 the company actually earns. That's a sky-high valuation, and it just shows you how much optimism was baked into that stock price.
And the options traders, they were all in on the hype. They traded over 4 million contracts, with almost 1 million more calls. That's bets on the price going up than puts. This was not the balanced 50-50 split we saw in the S&P 500. This was an overwhelmingly bullish stampede.
This speculative mood wasn't just in certain stocks either. The Bitcoin ETF was showing the same kind of strength. It rallied over 1.5% with its own set of bullish signals. So clearly, that appetite for risk was alive and well in these corners of the market.
Okay, now to understand our next clue, we gotta quickly talk about something called implied volatility, or IV. You can think of it like the market's weather forecast. It's a prediction for future price swings. When IV is low, the market is basically saying, we expect calm seas ahead.
Now check this out for the Bitcoin ETF. The market was forecasting unusual calm. That implied volatility was near a one-year low, in the first percentile. But its actual price movement, its historical volatility, has been totally average, right around the 49th percentile. That's a huge disconnect between what the market was expecting and what was actually happening.
In fact, the options market for the BTC ETF was showing some of the most one-sided bullishness we could find anywhere. A put/call ratio of 0.32 means that for every one bearish bet, there were more than 3 bullish bets sitting out there. People were getting really, really comfortable.
And now for our final clue. And honestly, this might be the most telling one of all. We have to look at what was happening beneath the surface, with the market's so-called fear gauge, the VIX.
So on the surface, the VIX seemed to be saying, nothing to see here, folks. A reading around 15 is historically pretty low. It suggests a calm, stable market. If this was the only number you looked at, you'd think everything was totally fine.
But, and this is a huge but, hidden in the options data was this shocking number, a put/call ratio of 0.21. Now remember, a bet on the VIX going up is a bet on fear and volatility coming into the market. This ratio means that for every one contract betting on calm, there were nearly 5 contracts betting on a storm. Traders were placing huge bets that the VIX was about to spike.
And we're not talking about small bets on a little jump in fear. The single most active option was for the VIX to spike all the way to 35. That's more than double where it was. And they were all calls. People were even buying calls way up at the $60 and $110 levels. These are lottery ticket bets on a massive market-shocking event. Okay, so let's put all the clues together now. We've got a cautious broad market, a speculative frenzy in a few hot assets, and this dark undercurrent of bets on a future shock. It's time to solve the mystery of the divergent market. The story of this one day was really 3 different stories playing out at the exact same time. First, you have the cautious core, where the big money was basically sitting on its hands. Then you have the speculative fringe, where hype was driving these wild rallies. And then, underneath it all, you had this hidden morning, these huge bets that the calm was about to break, and maybe break violently.
So this leaves us with one final and I think pretty provocative thought. You have a market being pulled in 3 different directions by these powerful opposing forces. So what happens when a cautious giant, a speculative mob, and a hidden fear all collide? Which one of these stories will be the one that wins out?